All right. On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I'm your host, Todd Schoenberger, and joining me today is Barbara Doran. She is the CEO of BD8 Capital Partners. Barbara, you have a market that is just soaring today. You have the Dow up over 400 points, and the catalyst for it is because of the end of the government shutdown, the record government shutdown, I should say. But historically speaking, Wall Street and traders, they never really paid attention to government shutdowns. Actually, they were more embraced, mainly with shutdowns and even gridlock. But now, do you think Wall Street is just paying a little bit too much attention to politics these days and maybe steering away from fundamental analysis?
Yeah, Todd, it's a good question because it's awfully coincidental that the market is taking off. And as you mentioned, the Dow intraday is making new highs, taking it a little bit away from NASDAQ. But I think the market or investors have not been paying that much attention to the shutdown because this seems to happen every year. This did go on longer than normal. And there's a question for some companies, how this is going to impact things. Like, for instance, McDonald's CEO was out last week saying that, hey, 40 million SNAP people get SNAP, which is basically food stamps. And about 12% of that goes into spending for food and services. So you could see some impact on the margin at companies like McDonald's and others that do service lower income. But I think it's really just because the earnings season continues to be very strong. As of the end of last week, you had over 90% of S&P 500 companies reporting. And there's been a record number reporting better than expected earnings and also revenues much higher than the 5 and 10-year averages, and the margins are good. So I think that's really what's fueling it. Of course, we've had 2 Fed cuts. We're not sure what's going to happen in December because we haven't had the economic data. It looks like inflation is sticky. We had the CPI number. It was high as expected, but less so. And also, with labor, sort of in some layoffs, no hiring, but that seems to be pretty stable. Again, people are looking at the regional Fed surveys, private data, whether it's Challenger or ADP. So it kind of looks like things are copacetic. Now, I think politics, certainly policies, it's distinct from politics, have played in, as we know. We saw it all in April in the big swoon after tariffs. And there certainly was a lot of uncertainty through the summer. How much is going to be passed on? What will the actual tariffs be? And who's going to pay for it? And I think, companies have been put on hold. They're starting to ease up and be able to make long-term plans. So I think it's really about earnings. I think it's that we seem to be starting a Fed easing cycle, and that the guidance, which is key, obviously, for companies for next year, looks pretty positive. So I think that's after we had a couple really shaky days last week, which I think flushed out probably a lot of people on margin, which were at record highs. And so I think that's really what's going on. And it's a time to rotate back in. People are looking for cheaper companies, maybe the Boeings, the United Healthcare, the Starbucks, and always, as we will see, taking some money out of the mega cap tech, where I think it will rotate back in, given their earnings and free cash flow profiles.
Well, I love your optimism. It's obvious that you're bullish. I mean, just off of that theme alone. But
Yes.
how do you balance that with, it's with these higher valuations right now, there has to be a sense of managing risk though for portfolios. How do you position, especially going into the end of the year and going into what I would expect that you're thinking is a very bullish 26? But as far as positioning and the allocations go, do you have any thoughts on that pattern?
Yeah, Todd, it's a big issue because valuation, as we know, it's just under 23 times, a little bit less after last week's action. But whenever you have a high valuation, particularly historically, even if you can make an argument, it should be higher given the composition of all these high-tech companies producing free cash flow and solid earnings, that it should be higher. Yes, it gives you pause because obviously valuation is key. You don't want to be buying stocks, great companies at the top, and have them back off and then have to wait another year for them to recover. So I think for me, I'm certainly not, I think there's much more to come from a lot of the mega cap names that we all know very well, whether it's the Metas and the Apples and the Amazons. So, but you have to trim back when they get overweighted. And I think you wait for moments like late last week, Thursday, Friday, where you get some of these names caught in big downdrafts. At the same time, I think the small cap play had been very much in play from the summer on until about mid-October, as people thought, oh, we're early stage, the Fed's easing. But I think you really have to stay away from them. Particularly a lot will play it through the Russell 2000, and something like 40+% of companies that don't make money. And typically the cost of capital is higher than the return on investment. So I think small caps, I think any of the speculative plays, the meme plays, where you've seen, a lot of money going back into, and I think the lower quality plays, which typically, again, if you think we're in an early cycle, can do well. And I think you have to stay away from them. And I think that's what is most vulnerable here.
So, and that's on the markets and as far as the portfolio strategy, but are there any specific sectors that are vulnerable?
Well, I think if you look at consumer discretion, I think that's you've
Okay.
got to be very picky in there, and particularly the restaurants like the McDonald's who cater to the lower income, and that's where all the reports are the higher income. And you had Bank of America Institute just had their monthly report out and saying, and they have some 78 million accounts, small business, big business, people, ordinary individuals, and they're seeing the upper income, that top third, is still spending. It is up year over year. It's the bottom third that's really struggling. And again, with the 40 million people on food stamps, you are going to see an impact on these lower levels. So I think you've got to be extremely careful. And even in great names that have growth prospects ahead, whether it's the Kavas of the world, you've got to really just be cautious here, because we are going to see some, more pullback. So, and we've got Christmas spending coming up, and that's where you're going to see the impact of tariffs, more in the clothing and the toys and things like that.
Yeah, you are right on the consumer discretionary. I'm shocked to see. I received an alert today from Target that Christmas decorations are 50% off. It's not even Thanksgiving, and how can they possibly be 50% off unless the markups were so high? But it's truly
Yeah.
incredible. But I am a bit concerned though, because one thing, let's stick to that a little bit on the consumer discretionary and the retailers. Normally, you hear about seasonal hiring. You get all these announcements from companies, especially the big box retailers, that they're going to hire temp workers. You haven't seen that a lot yet. What's your outlook for the labor picture? Because if you have lower income, and a lot of lower income individuals really rely on the seasonal employment, if it's not there, what does that tell us about the overall labor picture as we head into 26?
Well, I think it is important to watch. And certainly we've seen in the last few weeks through the earnings reports, companies like Amazon or UPS and others announcing layoffs. And it's hard to know, again, without other supporting economic data, is this the start of more layoffs, or is it just one-offs? Because we also know some of these companies are ahead of the curve in terms of using AI. Like Amazon apparently already has 1 million robots out there, helping in their distribution warehousing. And so that obviously, as that increases, you are going to see the productivity increase. You're going to see less need for lower skilled workers. So I think that we have to see what, if the temporary workers, they're hiring less, we're getting that news now, is that because they see lower demand, or it's really these productivity improvements, which are happening very quickly? So I think that, as we said, the lower income consumer, this could be a problem, but the majority of spending is by the higher income. And so it should hold up. And all the numbers, credit card companies have been reporting, travel companies like booking.com, they're not seeing a let up. So it really is, they're talking about this K-shaped economy, where the
Yeah.
higher end are doing well and the lower end are struggling.
Yeah, no, you are absolutely right on that one. Let's turn the page to AI. We've had you on many of our shows in the past. Technology always seems to be a common theme. Do you think that we're in an AI bubble though? Because the valuations, especially on the Mag 7 stocks, have just increased so much this year.
Yeah, I think that's always a question when you see so much money pouring into any sector or industry. You've got to ask the question, is there a bubble? We've seen this in the past, whether it was laying fiber, or we had, going into 2000, all these companies, that internet that went bust. But I think the difference here is, first off, the companies that are getting involved have tons of cash flow. They're very healthy balance sheets. And this AI thing is very real. This is not just a 6-month phenomenon, because it has the power to change everything in the way we do business, the way we interact with each other. Chat GPT at this point, for instance, has 600 million users a week, and it's still
Oh,
it's still growing exponentially.
wow.
So yeah, and so I think, and everywhere you read, you had AMD, just talking the last day or so about the demand they're seeing. It's insatiable, is the words that you're finding from that, and Nvidia's Jensen Huang, that it's just they can't meet it, and it's not going to be over in 6 months. And of course, is there overbuilding? Not yet, and that's always the question: is everybody's trying to get in this, but we're not going to see that. And so, like, for instance, AMD talked about visibility out 3 to 5 years. NVIDIA talking out 18 months plus, and they've never done that. And so, and the data center demand, the energy demands, and everybody's scrambling like mad to really, up the grid capability, because all the projections are we're going to have a serious problem if we don't get more energy sources. So I think this is very real. I think the valuations from time to time do get ahead of themselves. There's no question. But that's when they pull back, it's typically been a buying opportunity, and you just have to wait because, for instance, NVIDIA reports another week or two, next week actually, and I think you're going to see, people are expecting big numbers, but I think they're really going to be big, and their forecasts will be very positive.
So what you're saying is that AI is not a fad, is what you're
no,
going.
No, I think it's and that's yes, that was the short way to say it.
Yeah.
Absolutely.
Absolutely. So that's awesome. So one final question. We go into 2026. You obviously are bullish. Are you bullish for the entire year, or do you think we might have some trouble maybe in the second half of the year?
It's always hard to look out that far, but I think, when you look ahead to next year, you've got a couple positive things. Right now the CapEx outside, of the infrastructure build for AI, and that's been well publicized with Meta and Alphabet and Microsoft, really spending billions and billions. You still have the CapEx provisions in the recently passed tax bill that should start to kick in a meaningful way next year. And you've also got a lot of productivity improvements. Like right now, a lot of the S&P 500 companies are actively looking at how do they employ AI. They're implementing it, and it's happening very quickly. So those productivity positives should happen and start to really kick in, because this year we're focusing on makers of the AI chips and the building of the data centers, but you're going to be looking at the beneficiaries next year. And I always say Meta is the poster child for how effectively you can use AI, increasing their number of users, their engagement, their ad targeting. So I think we're going to see that kick in next year. And also one other thing, bank deregulation, if it goes through and looks like, it will, it's going to free up a lot more capital to lend out to businesses, to consumers. And of course, the more money you have to borrow and spend and invest, that should help the economy.
Yeah, I completely agree with you. And I've been asking a lot of experts like yourself this same question of what should we expect next year. It's 50-50. I mean, you got 50% thinking, yeah, things are going to be great. The big beautiful bill is going to really help, really accelerate. Plus, you have AI capex that's taking place, and you got this other half thinking the labor market's just going to bring everything down. So it remains to be seen. I know we'll have you back on the shows again, Barbara, and we'll follow up on this discussion. But I do appreciate you joining me today.
Delighted, Todd. Thanks so much. Always enjoyed talking with you.
Absolutely. Same here. I love it. So coming up tomorrow, Jeff Blazek from Neuberger Berman's joining me at 1 o'clock live on the Money Path. We definitely want to hear what he has to say. He has a few exclusives for us as well. So on behalf of Barbara Doran, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. We'll catch you next time. Take care. All right, Barbara, that was fantastic.